right, good afternoon, good evening, good morning, wherever you are out there. Hey, welcome to the 10X Tribe coaching session for today. Today is Tuesday, the 20th of April in 2021. Welcome aboard, whether or not you're watching live or whether you're watching this through a replay at some point in the future. Welcome aboard, everybody. All right, so we've got some interesting movement in the market today. And so this is why I picked this specific topic today. Let's get into it with today's topic, which is matching the market character to different strategies. What approach should you be taking when the market shows different character? So you might be saying, what on earth are you talking about character? All right. Conveniently, I prepared that response to that question. So the stock market is changing all the time underneath our feet. It literally goes through different seasons that are correlated to investor sentiment. Most retail investors don't really live through all the seasons of movement. Most are only around during the party time. So when markets are going higher, this is where a lot of people are attracted to the market because it seems like everybody's making easy money out there and you want a piece of that too. And so that will last for a certain amount of time, and then sooner or later, things start getting to be tough. And this is where people say, you know what, I don't really want to do this anymore. I don't know what I'm doing. Or, maybe I'll go into that Amway distributorship that I always meant to do. Or maybe they go into flipping houses or whatever. People are attracted to something that's moving, and then just as quickly they jump off the ship when they don't understand what's going on. However, that doesn't need to be the case. You don't need to do it that way because you can actually anticipate these kind of things. You can make money just as easily on the way down if you know what you're doing, or during sideways markets as well too. And then you're going to be well positioned on the way back up when the recovery rally does happen. It's just a little bit of knowledge, understanding what the market really does. So think of this as seasons of the market through the year. So this is going back a long way, back to 1994. You can see we had these, super bull markets and then corrected bears, bull markets and bear markets. And even though we've been in this great big swing to the upside, it doesn't seem like we've had that much volatility. Hey, everybody, welcome aboard. We got DG and Noza Capital. Welcome aboard. Glad to see people are joining me live here today on a Tuesday. So you look at this in the rearview mirror, and that doesn't seem like it's that big of a deal. These were huge deals. These were enormously difficult challenges for investors, as was this move last year, as was the move at the end of 2018. These are all very difficult scenarios for investors. But obviously, those are very different from when the market was just seemingly without end to the upside. As we've seen over the years, we've had these types of moves, and even recently, we've put on another 8% to the upside, seemingly in just about 2 weeks. There are different seasons to the market. So we have to turn ourselves into weather forecasters and understand what's going on. So if you conduct your trading as if it's always a bull market, which is the way majority of investors are, sometimes you'll be going with the flow, and other times you'll wonder why nothing works. What's going on? Okay, so fortunately, we can identify these seasons through some what I call well-worn footprints that don't change too much. Now, I do believe there is a big difference. If we go back to this chart, there is a big difference between the types of moves that we've seen here versus what we saw here. In some ways, with all this quantitative easing and money printing and 0% interest rates, we've dramatically increased the volatility to the market. So what used to take a year and a half, what used to take 18 months to go through, now we go through in 3 weeks. And I believe the next move down will go higher faster, will go lower faster. The volatility and the velocity of this market has changed over the years. And this is one thing, again, that we need to understand, that if you're reading textbooks from 20, 30 years ago, things aren't going to quite operate in the same manner. So this business is always about adapting, adopting innovation, and making things work for you with today's market. Can't trade the market that you want, only the one that's in front of you. So things change over time. Now, I want to go into the different types of market character. So I've narrowed it down to 4 of them, and this comes through, this is a book that I read probably 15 years ago that did a great job of illustrating what different types of character that they were. And the author's name is Curtis Faith. I can't remember the exact title of the book, but it was like the Turtle Trader something. He was one of the original turtle traders back from the 1980s. They took a bunch of people who had no market experience, indoctrinated them within a week or two, and said, okay, go trade. It was almost the storyline behind Trading Places. So the first type of market character is quiet and trending. And this is exactly how it sounds like it is. It's quiet. Market generally moves in this manner, and we get a lot of stair-stepping. Range expansion goes to range contraction, which goes back to range expansion again, to range contraction, and it generally just stair-steps higher. And if you're looking on a monthly or weekly chart, you don't even see this level of detail. You just see the thing just doing something like this. And this will attract a lot of people over time, right? Mortimer, yeah, there we go. So quiet trending price behavior is what we tend to see most of the time. Now, what I say is that these types of markets are very linear. Linear means for every, range expansion, you have a range contraction. Range expansion and range contraction. Everything seems to work really, really well. When the price pulls back, it pulls back to a well-known fib retracement. So it pulls back to like 38.2 or 50%. And then when we see the momentum coming back in, all the signals line up perfectly. It's almost like technical analysis was born for times like this. Everything works so well. And this follows accumulation during a bull market. So everything's just very neat and tidy. And we have many, many times where we see this, the majority of the time, hey, Mark, is quiet and trending price behavior. So during the mid-90s, we saw a lot of this. And even into the late 90s, we saw a lot of this quiet and trending price behavior. The rally between 2003 up until 2007 was very quiet and very trending price behavior. And then after the bear market of 2008, 2009, we got into some different time frames here where we saw various elements of this for months at a time, if not more than years. And then, of course, we had our post-election bull market that topped out in early 2018. And then just different times during this period, the majority of this time has been quiet and trending price behavior. This is what we see the majority of the time. Most of the strategies that I personally trade are set for this type of quiet and trending price behavior because we get it most of the time, right? You're going to design things for the majority of when you see something like this. So roads are designed to handle the capacity that you see most of the time. Maybe not the outliers, but most of the time. And so it makes sense to do this. It makes sense to orchestrate the majority of your strategies around quiet and trending price behaviors, to be an expert at that. So one thing you will hear is that everyone's a genius in a bull market because everything seems to make sense. 1 + 1 = 2. 2 + 2 is 4. Everything makes sense. All the technicals work out for whatever system that you use. Typically, a lot of people can look back on these and say, yep, it works all the time, every time. But unfortunately, it doesn't stay like that all the time. Sideways and volatile is the next character that comes along. So quiet and trending markets will always transition into sideways and volatile. like this. So nice, quiet, linear price action. All of a sudden, everything just goes to hell all of a sudden, and nothing makes sense. So sideways and volatile often transitions back into quiet and trending. But sometimes also, though, you have to keep this in mind, is that sometimes it will transition into trending and volatile, which is code word for bear market. So we never know where this is going to go from here. We can't presume anything, but we always know that quiet and trending will transition into this much louder, much more chaotic sideways and volatile price behavior. So if we look at the same chart, we can see sideways and volatile price behavior up at the market top in 2000. Also in 2007 to 2008, we saw a lot of this transition, as well as we saw this transition in 2010 and also in 2011. So that was a rough couple of years where we had a lot of chop, a lot of little corrections going on. And then 2015, 2016, we had sideways and volatile. Went from a nice quiet bull market and into much more volatility, much more sideways price behavior. And then, of course, in 2018, 2019, the entire year 2019 seemed to be one big noisy market, right? And then we've had various periods during 2020 and into early 2021 as well, where we've had sideways and volatile transitions. And then we get into the nasty one, the character that shall not be named, but it's trending and volatile. So sideways and volatile may transition into trending and volatile, but doesn't have to. So here's nice quiet trending, transitions into sideways and volatile, and sometimes it will just keep on going. It's very dangerous, very difficult to trade. You're going to look back on a chart and say, oh man, I can't wait for my next bear market. I remember saying this a long time ago, because when I first started trading, it was during a very quiet, trending market. It was very boring, and I had the attitude to say, hey, I can't wait for my first bear market. I want to make a lot of money in a hurry. Well, it was not like that at all. It was very difficult. It was very difficult to adapt yourself to what's happening here. And one thing that people don't understand is that a lot of people think that you can just take a quiet and trending strategy that you're scanning for and just flip it upside down. Just change all the parameters to it and say, hey, I want to do the same scan for a bearish market that's trending to the downside. Got news for you. They don't move in the same manner. They don't move in the same way. Hey, Ray, good to see you again. So this is where we see very damaging bear market behavior. In fact, it's so damaging, most people will just give up and quit. Most retail investors will say, stuff this. This makes no sense. I can't get my head wrapped around where the price is going. It's because they're using the same old techniques and mindset and everything else from quiet and trending. They're not adapting their game to what's happening. The other thing, too, that we'll see is that when we truly transition from quiet and trending very quickly into trending and volatile, which is what we saw back in February and March of 2020, very quick transition. It spawns from very frothy, euphoric investor conditions. So literally 2 weeks before this, markets were at all-time highs and everybody was all, high-fiving each other and, playing around the carousel and thinking that this game was going to, and next thing you know, we're down 35% in 3 weeks. Very difficult to wrap your head around that. And it takes some experience. It takes a couple of cycles to go through and learn how to play stuff like that. So trending and volatile price behavior, we do not see that often. We certainly saw that back in 2000, 2001, 2002, ending in 2003. And then, of course, in 2007, 2008 was trending and volatile. And then we've had some periods at the end of 2018 as well as in 2020, where we've had this as well too. Very elusive, does not show up all that often, is devastating when it shows though, because typically it's right after a period of very, very strong price behavior, and all that momentum that everybody wants to just keep, playing along to the long side. It's very difficult to break that habit because you just want it to go back to where it was. So half of the problems that we're talking about here are just mental, right? These are mental mistakes because we're not adapting to the new character of the market. Now there is the fourth one, which is called sideways and quiet. Very rarely seen these days with the advent of massive QE and easing and printing and everything else. So I can only identify really a couple of times where we've had this, like in the mid-aughts here, was very quiet and sideways. We've also had some periods like back in 2015 where you basically had to poke the market to see whether it was alive or not. And it was alive. It did start moving, and it did drop 20% in no time at all. So there is a different flow. There's this defined regular flow between these different market characters. The ones that we've talked about, between quiet and trending to sideways and volatile, maybe back to quiet and trending again, or to trending and volatile. Most of the time we'll see markets in accumulation with quiet and trending character. Most of the time we're going to see this just, chugging higher like this, chugging higher. Occasionally we'll see some sideways and volatile, but most of the time it reverts back to this trend with all the money in the streets, all the stimulus that they're printing out of thin air. Money's got to go somewhere. Lack of money is not a problem this time. It was 13 years ago. We had credit markets frozen up. There was no money. That's not the problem anymore. They've created different problems now. This is the most normal condition with very linear, logical conditions, as we say. It's much simpler to analyze, and the transition always moves to sideways and volatile, as we're seeing the last 2 days. We're seeing right in front of our face right now, sideways and volatile cropping up from quiet and trending. Last 2 days, as I've been warning people in my room, be careful, be careful, be careful. So this transition is very disturbing to most investors who cannot seem to get in sync with the markets anymore when we transition from quiet and trending to sideways and volatile. The setups that used to work regularly now don't work so well anymore. What's going on? What's wrong with this? It must be somebody else, right? It must be the strategy is a problem. It must be the broker is the problem. Oh, I'm not getting good fills anymore. It must be the guru is the problem. That guy doesn't know what he's talking about, right? So instead of taking ownership for what's happening because you're getting a transition change in the market, this is what's happening. So sideways and volatile is very non-linear price behavior. It doesn't make sense. 1 + 1 does not equal 2. You're not going to find any indicators to tell you what's going on with this. You might get some leading indicators that show you that you're about to see something like this. So you might get divergence indicators showing that, hey, markets are heading higher, but on fewer advancers, or a smaller percentage of stocks above their 200-day moving average. So it's coasting and it's about to drop. Those kind of things. So you can see those kind of things, but it is very difficult to pick a top. Realized price volatility, implied volatility, ATR, which is average true range, all rise during this period. So quiet and trending to sideways and volatile, quiet, small volatility, and then all of a sudden it gets loud and noisy. This is what happens. Gets loud and noisy. Much bigger range, much bigger implied volatility. Every rally which appears to reclaim the former uptrend fails. So this is what happens when all of a sudden we go through a big dip. What happens is at some point the price will rise again. And then people say, oh, it was just a quick dip. And so they'll jump on board and they'll get taken underwater again. And then the next rally comes up and they say, oh, here's my entry point, looking good. And then, and this is what kills people. And then what eventually happens is people stop buying the dip, and then that's where it takes off again. So most of the time, the market eventually breaks higher and back into quiet and trending. But no one's on board with this move because everyone's tired of being faked out and losing money. It's amazing how this works. It's amazing how this works. So the majority of the time, sideways and volatile transitions back into quiet and trending. So I'm saying the same thing again here several times to hopefully repetition is the mother of skill, and I'm adequately communicating this, is that most of the time when we transition from quiet and trending into sideways and volatile, eventually it transitions back again. Most of the time. On occasion, a sideways and volatile market will just keep bleeding lower. If you want to see an example of this, look at 2007 to 2008, especially the early part of 2008. Even the end of 2018 was the same thing. The end of 2018 is a good learning lesson for this. The transition relief rally never materializes. So people keep buying the dip and then they keep going underwater. Every relief rally gets destroyed. Eventually, the selling hits a fever pitch near the bottom. So keep in mind that when you transition into trending and volatile, what usually happens is you get a waterfall decline near the bottom where it just completely eats it. And you'll see things like this. You'll see lower trend lines get broken. So descending patterns should break to the upside, but usually what you'll see is that they'll break down through the lower trend line and just keep on going. And these will be a very high volume waterfall decline. These are unbelievable to watch in person. If you've ever seen one in person, they're unbelievable opportunities. Because usually you get an air pocket and it just drops like a stone through this. And then what you'll see eventually is you'll see it recover from there. This is what we've seen in the past. But the selling is always the strongest at the very bottom of a move. Look at last March, last year. So it's not an easy transition to spot because they're we don't see them that often. We do not see them that often. So volatile and trending always transitions back to quiet and trending. But nobody's going to trust it. How did you feel a year ago in April of 2020? Were you confidently long? Or were you watching TV going, oh no, it's another bad day, it's another gap down, it's another lock limit? Or did you step in front of the freight train and say, stop, it's time to go backwards? This is a massively opportunistic transition to spot, especially down at the bottom. Okay, so this cycle repeats over and over again and will continue to repeat as long as human emotion is part of financial markets. And guess what? Even when the robots trade for us, they're going to be trading based on the programming of human beings. Human emotion is going to take a long time to divorce from financial markets, and then when that happens, there'll be no edge. At that point, I probably will have assumed room temperature. So I hope you can see now that each different season offers different trading opportunities, and being able to not only spot the character and then apply the right strategies is paramount to success. So let's talk a couple of minutes here. We'll finish up in about 10 minutes or so. Strategies to match market character. Now I'm going to break this down to the beginning and the end of quiet and trending. So think about this. You're coming off of a market bottom, and now all of a sudden you start to work higher like this. The beginning of that phase, when you transition into quiet and trending, is going to be much, much different than the end of quiet and trending. So I'm going to say beginning and end, or early and late quiet and trending. So this is an example of early quiet and trending. This is massive opportunity down here, but it doesn't feel very good, right? This is where you get the disbelief phase of the market rally. Nobody can believe it. You get acceptance up here. People accept the fact that the market is rallying, and then you get euphoria up in this area. And this is very dangerous. So this is early, and this is late, quiet and trending. And we can see this down here. This is early, this is late, this is early, this is late, all the way along here. Early quiet and trending is going to be a huge challenge for you to go against the grain if you're new to trading, because there's a massive edge to go bullish while everybody else is in fear. Everybody else has got their head in the sand and saying, I don't want to look at my broker statements anymore. I quit. Just let me know when this is all over with. That's the mindset of most people down at the bottom of the move. But those that can think clearly, and quite honestly, the best way to think clearly is not to listen to the news. Stay the hell out of the mainstream media. The implied volatility will be heavily overstated. And this is what we want to do. We want to sell this high implied volatility like crazy. We want to be heavily selling puts and put credit spreads. Be careful with iron condors. Everybody says, when the implied volatility is high, you must sell everything. No, don't sell everything. Don't sell iron condors during that period, because your call spreads are going to get run over. I don't care how good you are. They're going to get run over, and it's going to cause problems. Zero DTE, this is 0 days to expiration strategies. These are the ones where we set up in the morning and we try to get in, get our fair share, get out within an hour or so. They work very well during this period as the implied volatility is consistently overstated. We had a great summer last year with 0 DTEs. It was a lot of fun because the implied volatility was consistently overstated. The VIX stayed at like 30 for like months and eventually dragged down into 20, which is still elevated. Now, late quiet and trending, this is near a mature bull market. This is where we are right now. The market has turned into a musical chairs opportunity, right? So the music's playing, everybody's walking around the chairs, and then when the music stops, guess what? There's literally no chairs to be found. Everything is great as long as the music's playing. Spotting the true top is extremely difficult. I've said this again and again. So markets will take this sort of S-shaped curve. You can go back and look at them all. Here's the short covering that comes out of the bottom. There's a very thick, choppy period in the middle. And then eventually you see the market taking off again and you get into this runaway market. This is where we are right now. Now, where's the top of this? I don't know, and I will never know until we finally transition into a downtrend. It is probably the most confounding thing, and I don't care what anybody says, you can't spot the top because it is complete and utter emotion that drives the top. It's fear of being left out. It's fear of missing out. And it's, from the bear's perspective, it's fear of loss. They're getting run over yet again. Very, very emotional. Implied and realized volatility will be very low. This is why you got to be careful. A lot of risk to be a put seller at these prices. So since implied volatility is low, it's better to be a net buyer of premium and just play the trend for as long as it holds out. There's a class that I recently put on, which is called Crash Proof Your Portfolio. And one of the concepts that we talked about is actually called portfolio substitution. At some point, what you can do is, as you get near this top here, and when markets are showing an almost infinite slope, that's probably a good time to do it. What you can do is you can just take your current portfolio cash it out, and then buy some long calls for a fixed fee. Maybe you're just putting 5% of your cash into some long calls, something like that. So you can take all of the downside risk out minus that 5% for the long calls, and just let them do the work. And if it blows up, then great. You can take profits into that point. And if it drops like a stone, then great. You can say, oops, well, at least I saved 95% of my capital. So that's what I call portfolio replacement to keep black swan risk low. So your objective is to stay as long as you can at the party, but not be a bag holder. Very, very difficult to do. Very difficult to do unless you're very well prepared for this. Zero DTE works well, as it has been working well for us lately, but you've got to focus on minimizing hold time and avoid high risk scenarios. Yesterday, I said no zero DTEs. What happened? Half an hour into the session, all of a sudden it pukes. Knowing when to avoid the high risk scenarios is important. Sideways and volatile, the end of a quiet and trending phase with its prolonged euphoria does not adequately prepare traders for the transition into sideways and volatile. So it's always, when you transition into sideways and volatile, transitioning into sideways and volatile is always a shock, always a shock. And I think we may be doing this pretty soon over here. So a lot of these are transitions. It's never at a timely, because this is when typically people are jumping under the market. They're jumping in here, they're jumping in here, they're jumping in here. They're sensing that there's boundless opportunity and a lack of risk. And this is why people jump onto it, because it looks like easy money. And it's always the undoing of the retail trader. So the transition from quiet to trending to sideways to volatile is always a big surprise. My hope is that you're going to be less surprised next time. Realized an implied volatility spike higher in a short period of time. This can be a good time to establish range-bound short trades like iron condors and time spreads. So the transition, once it starts to transition, that's the time to do it. Although with time spreads, you have to do it before the transition starts. Very tricky to time that. You can always use the pullback to establish a new short position, right? So if you're going up like this, first pullback comes along, implied volatility shoots up. Now you can sell something down in this area. If you're a day trader, intraday future swings are going to be crazy. This is where you can make up a year's worth of profit in a short period of time. It's going to be fast and wide. So understand that most of these sideways and volatile phases will again revert back up to the upside. So something that we can do to anticipate the sideways and volatile transition is simply to put the chop index on the weekly chart and look for some of these super low readings where we have exhaustion on the weekly chart. We're not there yet. Right now, we're not there yet, but we will be soon if we break higher from here. That may do it for the year. But notice all of these had a very similar signature to them. Very similar signature that told you when to lighten up and when to reduce risk. So a lot of people want to get bearish. Everybody wants to play bearish inside the correction, but it's not as easy as you might suspect. It will take some time to detect. I'm going to show you an example in the next slide here to detect the character shift. By that time, the move might be over. So learn how to use trend lines to judge the price action and establish bearish position on rips. Never chase the price lower. Here's an example of what I'm talking about here. So here's a quiet and trending market that it's all of a sudden transitions into sideways and volatile. And up until this point, you're still thinking that everything's heading higher. And then all of a sudden, you get a little dip, and then all of a sudden the bottom falls out, and all of a sudden, this is not good. You're not even aware that it's moved into a downtrend. This is an hourly chart, by the way. You're not even aware until right there that it's a downtrend. And so you're like, okay, next time we get a rip up here, I'm going to short it. Well, boom, goodbye. You're too late. This is why I'm saying it's very difficult to play this transition. It's very difficult to play bearish. You got to be in it to win it. If you want to win at the bearish game, you've got to be in it to win it. You've got to be able to carry a bearish portfolio forward and be in it to win it. You cannot time the downside move with any kind of effectiveness. Now, this one was a little easier. This one, we started to transition, and then right there, that's your lower high. But really, the best job that you could have done was to enter right there on this test of the trend line and catch that move. So trying to time these things is really, really difficult. And then by the time that the price comes back up to there, here's your higher low, higher high combination, breaks the trend line, you're done. That's it. That's all you get. All right, do a quick summary here, and then I'll take any questions. So if there's any questions, now would be the time to type them in. So there's 4 different types of market character, 3 of which we see repeatedly and follow the same cyclic pattern again and again and again. Quiet and trending, you're going to see the majority of the time. Quiet and trending always transitions to sideways and volatile. Sideways and volatile usually transitions back to quiet and trending again, but sometimes will drop into a full trending and volatile bear. Both sideways and volatile and trending and volatile revert back to quiet and trending again. So whether or not you have a sideways and volatile or whether you have trending and volatile, they will always eventually revert back into quiet and trending again. The overall sentiment and mood will always be the opposite of the opportunity. Don't get caught watching the mainstream media. Learn to divorce your, excuse me, I'm starting to lose it here. Learn to divorce your opinions from what the price is showing. Okay, this is probably going to be the most difficult part of doing this, is that what you're going to feel is common sense is not going to work. If you're going against, if you're making the difficult decisions that feel like completely suicidal, you're probably doing it right. And this is what I say all the time, is that the best trades that you're ever going to make are the ones that feel the worst to place. Okay, so there's a question that came in from DG. Aside from price action, chop, and volume, what signals are you looking for a reversal? One of them that I will see is, if you go to stockcharts.com, I believe it's like SPX A200R. And that's under stockcharts.com. What that is showing is the percentage of S&P 500 stocks that are above the 200-day moving average. And what you will see is on rallies, you will see the price making new highs, but on this indicator, when it's under danger time, what you will see is you'll see the price making new highs like this, but you're going to see that study like this, all of a sudden putting in lower highs like this. And what that means is that you've got fewer and fewer stocks that are above their 200-day moving average. You've got more and more stocks on the S&P 500 that are starting to transition early into downtrends. And so you've got fewer and fewer that are actually pulling everything higher. And we've seen this for years and years and years. So it's not a timing signal. It's more of just an early warning radar to say, uh-oh, you got participation divergence showing up. And eventually you should expect to see some type of stronger correction to the downside. So that is one that I use. There's other people that use different oscillators and so forth, and whatever makes sense to you. But price and the CHOP index are probably the major things that I'm looking at. What do I think about the growth stocks right now, and what will happen to them if the whole market crashes? Well, I don't think we're going to get a crash right yet. Not yet. I don't think it's ready for a crash. I think there's still too much money that's out there. Although this has been a really weird transition. It's been a really weird rotation that we've seen over the last couple of months. We've seen all this money kind of like rotate out of tech and all these high growth companies, and certainly out of things like SPACs, and rotate into some very, pedestrian type stocks. It's been unusual. Even seeing the financials taking off, and it makes sense for the financials to go just because of potentially interest rates going higher. It gives them more margin. But we're seeing a whole new set of leadership, and it's a little unsettling right now. It's a little bit difficult to get in the groove of that after being, just follow tech for the last 15 years, and that's all you had to do. So, okay, any other questions for today? Any other questions for today? Don't forget, if you guys are not a member of our 10X tribe, you can join for free. So if you just go out to elite.readyset.trade, you can join for free, and we will invite you to all kinds of things like this. There's free courses that are out there. There's free market minutes that I do on a regular basis where I see something happening. I'll just go ahead and post something in there. You can ask questions. You can chat with other people. It's part of a community. So we're just trying to build this. We're trying to make a difference in the world out there. Okay, thanks everybody for hanging out with me here today. Again, my name is Doc Severson. This has been the 10X Tribe coaching session, and I thank everybody out there for hanging out with us here today. You guys take care, and we will see you fairly soon. All right, see you guys. We'll see you next week.